As good as it gets seems to be a thematic that is gripping the share markets. We have seen quite some negative reaction last week. Do you agree to that notion that we are looking at as good as it gets in the economies?
From a cyclical standpoint, it seems like it's as good as it gets. We see the credit impulse is rolling over, so credit growth is slowing, and then some cyclical stocks are suffering. But from our perspective, as good as it gets is actually pretty good, because that means interest rates are low, and the companies that play on the bigger themes that play out over 3 to 4 to 5 to 10 years, they keep on performing.
And some of the subjects that are saying that we are maybe as good as it gets, it's the supply chain, it's the US taxes that might get raised, it's actually the global taxes that might get raised. So on a micro level, that the companies has really blown out results, but this might slow down. What are you thinking about that?
Some of those threats or worries actually do not concern us as much, because if you look at taxes, for instance, it's still unknown what the tax situation will be. But what we do know is that our companies generate so much cash, so they're more insulated towards higher taxes. So if you take Microsoft, for example, they just announced yesterday that they're buying back $60 billion of shares, and that's what they generate in free cash flow, for instance. And then our companies also tend to be able to hike prices, so they're in a position where they can actually raise prices. And then if you also look at your first part of that question, sort of supply constraints, we actually have a positive exposure towards that, because we own a lot of the semiconductor producers. So we own TSMC, who's benefiting from this supply shortage, and they're raising prices for the third time this year.
And what about the interest? We haven't really seen it spike up. Inflation is coming, but it's not spiking up. What are your viewpoint on the interest side? Is that going to go much up, or is going to stay here? And how do you look at it? Is it positive for you if it stays here?
Yeah, what's interesting is if you look at last year, so interest rates went from 50, if you look at the US 10-year, from 50 basis points to 100 in 5 months. And that's obviously going to be a headwind for us, but we still had a great year. And then if you look at interest rates this year, and we're at 1.3, if they double in 5 months, that's going to be a headwind, a clear headwind for us and for the market. But it seems that we're not getting back to those levels.
And also, you keep saying it's not bad for us. My wisdom in the share market, when the economy tops, shares are going to have a tougher time. Can you kind of elaborate a little why maybe your investment philosophy, or where you actually should be looking at investing to avoid it being a problem if we have really peaked in the economy?
Yeah, so I guess our investment style suffers the most if we have violently exploding economies moving higher, or if we have a total depression. But in that middle ground where economies grow a little bit or actually grow quite slow, we tend to do quite well. Because our companies, they play on things that are more insulated from the general economy. So if you take Novo Nordisk, for instance, a big holding, we have 650 million obese people. And if you have a drug that can reduce your weight by 16%, you're in the right position. And obesity have no correlation with the economy at all. And then you have companies that are somewhat isolated. We talked about semiconductors. That's a cyclical industry, but this time around it's more structural than in the past. And then there's themes, I would say, that end up in the middle of that. So the move to the cloud, for instance. Companies such as us taking our data sets, our calculations, and moving it from on-premise, so in this office, to a cloud. That's a $2 trillion transition that's happening over 10 years. That's also somewhat isolated from the general economy. In fact, what we've seen during COVID is that's actually accelerated. So companies are now moving more data sets to the cloud. They're using more Teams and more Zoom. So it's quite interesting to see that if the general economy slows, we have some exposure that might be a little bit of a area of concern, but most of them actually benefit or are very uncorrelated to the economy.
So if I should try and make a conclusion, it is that it's not impossible to be an investor even if the economies are topping out, but you kind of need to seek the areas out in the market that will keep growing no matter of that, and that is actually where you are looking right now, because you actually think that we might have seen the peak in that. Is that correct?
There's always companies to take a look at. We're stock pickers, and if you look at the stock market over longer time spans, there's usually just a few companies that generate all the value, and that's where we focused. So if you look at the last 40 years, only around 1,000 companies stood for almost all value creation. And as concentrated long-term stock pickers, that's where we're looking.
And also, if we're looking at this supply chain, which might be the negative impulse that we are seeing in the coming quarters, how are you projecting? Are you looking at the moth of the companies? Is that the most important thing for you when you look at it? Are they protected? You mentioned that being able to raise prices. Is that also something you think will be very important to look at in the coming months?
Yeah, if we get inflation, and there's a big debate if inflation is transitory, so if it's going away, or if it's going to be sustained. But even if it's sustained at somewhat higher levels, and you can raise prices, like TSMC raising prices for the 3rd time this year, then you're more insulated. So the moats are super important, and a big, I guess, answer if you actually have a moat is if you can raise prices.